Hi, and welcome to another episode of Nursing Your Way to Wealth, where a mental health nurse and an accountant talk about wealth creation, personal development, and financial independence in the UK to help you live the life you deserve.
Hi, everybody. Welcome back. And today is quite an interesting and I guess hopefully very relevant episode. I know we record these maybe a few weeks in lag, but we're in the week of commencing the 5th of August. And if you were to have woke up and checked the news on the 5th of August, you'd have probably been confronted with like the Japanese stock market's going down. I think it was down like 12% that day. The US followed, so Europe followed, and then so did the US. And if you were to be reading the financial press, it was all doom and gloom, and you'd be feel yourself lucky to still be solvent at the end of the week. And so this episode, we're covering really just talking about the stock market volatility, how you hold your nerve, how you go about investing in when it is volatile, and hopefully we'll give you some facts and figures to help allay the fears that all is not lost and that investing for the long term is still the right thing to do. So yeah, I mean, Alex, I know that obviously we mentioned before the pod about this, but yeah, did you get pings and notifications from Yahoo Finance like I did, saying that it's the end of the world?
No, because I don't have anything like that notified on my phone whatsoever on purpose. I don't follow particular kind of like news stories or anything like that. And most of my news, if we're being totally transparent here, comes from Reddit. So if it makes the front page and it's such a humongous thing, then I might read about it. But yeah, really no. I didn't really realize it until I randomly just kind of checked my portfolio, and I was like, oh, I'm sure that was a few thousand higher than it is now. So then I did a bit more looking, and I saw that some of the funds I'm invested in had gone down a little bit, and I then read it a little bit wider about the news, but I didn't get an immediate kind of ping. If you'd asked me on Monday if I hadn't checked my portfolio, I probably wouldn't have known about it. So I'm yeah, at that point, I thought to myself, because I've been through a market dip before for COVID, and I had a lot less money in the market than I do now. And my immediate thought was actually, do I have any spare money to put in, because it's cheaper now to buy them. Like, stuff is on sale. And I will dig a bit more into this later, but people generally seem to like buying stocks when they're higher priced, and they feel negatively about them when they're lower priced.
Yeah, it's a bit of a strange one, the stock market, in that it seems to be like the only market that operates in that way. Like if you buying your groceries and the supermarkets were like, oh, everything's gone up by 10%. It's akin to everybody rushing out to buy their groceries, and then when if they were to discount them by 10%, people not buying anything. So I think with the stock market, it's I guess one thing to really appreciate is they are volatile. You often get quoted around, the average return of the stock market is, 10, 11% per year, something like that. But that is not equivalent to like a savings account where it's nice and steady, 10% year one, 10% year two, 10% year three. It is volatile. And so the price and maybe one year it might be up by 20%, one year it might be flat, one year it might be down by 10%. It's very normal for the markets to be behaving like this. And ultimately, there's people behind these buying decisions, and people are very emotional beings. And so you get a lot of fear and a lot of greed in the markets. And this is where you can often see like huge price rises in certain stocks. Was it like the GameStop saga, which came out of Reddit, I think, and even companies like Nvidia, who've just like tripled in value over the last like 6 months. But so I think it is all part and parcel of it. I think the important thing to remember when with investing is it is really for the long term. So you're looking at 10 years plus, probably longer, and that money is for your future self. what the stock market is, you're buying into a business. So there is a company behind that, either selling a product or selling a service, earning money for, generating revenues with people employed, to do that. It is real business. And day to day, even though the markets go a bit wild, it's very, very unlikely that the fundamental business has changed from day one to day two. And I think that's what's almost remembering, almost like back to first principles around what the stock market is there for, is that there's a nice quote I've heard, which is, over the long term, the stock market is a weighing machine, and in the short term, it's a voting machine. And ultimately, the fundamentals of a business, so the cash it produces, the products it makes, those are the things which grow over time and ultimately cause the stock markets to increase. But yeah, I'm not saying it's pleasant at all to see your portfolio go down. I think it hurts twice as much. Does it hurt twice? A loss hurts twice as much, I think I've heard, than the benefit of if you were to win something. But yeah, if you were to they win £10 or lose £10, that you would hurt more from the loss than you would by the gain.
You absolutely would, and you're right. It's the concept called loss aversion, which I know we've spoken about before. And I think just to elaborate a little bit further on your point about the stock market being companies, I mean, whilst you were talking, I've looked around me, and I can find many things around my house, on my driveway, that are companies that are listed on the stock exchange. So, for example, I've got an HP laptop and an HP monitor and a Blue Yeti microphone and a Volvo on the drive and a Fiat. And these are all companies that are listed on the exchange, and people use the services of these companies all day, every day. If you have any form of office job, I guarantee you Microsoft will play a role in that. And that's one of the companies in an index fund like the S&P 500. If you have any other kind of tech at home, it might be from Apple, it might be from Microsoft, might be Google, who knows? But these are companies that you're willing and we are willing to give our money for their products. So with that in mind, we perhaps should be willing to give them a bit of our money to help them grow our money, because they're some of the brightest minds across the world. They've turned ideas and concepts into £1 billion businesses. Yes, that's over a lot of time, but we're giving them money to grow over a long time as well. I mean, I've just turned 36. I've got no plan at all to take any of the money out of my investments for the next 2 decades, possibly longer. So I can leave it there and I can ride out any up and down choppiness, any waves kind of in the process here. So it would be very different if you needed the money week on week. And Alex and I, we've always said, don't invest any money that you need within at least 5 years, ideally 10. And a lot of people invest money and they don't even realize it. So if you've got a company pension, that will be invested somewhere. So you're probably doing it anyway. And it's just adding a bit more intention to the money that you have. So the money that I invest now is for me and my wife in the future. I'm paying future me so I can allow myself to spend and have nice things in the future as well as now. And I think if we think about the volatility of the stock market, and you said, Alex, that the annual return is an average of kind of 10, 11% for something like the S&P 500. It can go up 5% one year, down 20 another year, up 40 another year. The higher the number, the rarer the event. But if we think about the COVID pandemic, 2019, 2020, my portfolio at that point went down 30, I think 35, 36%. And say you're in the market for a pair of shoes and you find the pair of shoes you want and you love it and they're great. And then there's a sale the day you go and buy them and they're 35% off. You're not going to walk out and be like, actually, no, I'd like to buy them when they're back at full price, please. You'd buy a pair. You probably consider buying two because they're on such a discount. So that's where a little bit of rational thinking, a little bit of emotional regulation comes in. That if you've planned your finances right and you have some spare discretionary cash flow, which all that means is spare money at the end of the month. So sorry for the technical term. And if you have a good well-stocked emergency fund, so you can live a couple of months, 3, 6, 9, 12, whatever suits you. If you can live for that amount of time without having to dip into your stock portfolio, then now is the time 100% to buy because things are cheaper.
Yeah, I think that point on the emergency fund is really important because it is that essentially your emergency fund is your buffer between you and like what things can happen in life. But it's you really want to leave your shares and your stock market investments untouched, and because nobody wants to be a forced seller of things. And if you're all if 100% of your cash is invested in the stock market, and especially in an ISA, because once you take that money out of an ISA, you can't put it back in, which is a very beneficial tax benefit, certainly as the portfolio grows over time. But yeah, completely agree on that. Just see these down days as opportunities as opposed to getting scared and worried and thinking, oh, I'm just going to then move to cash.
It's a sale.
It is, yeah,
Basically, it's a sale that'll make future you richer than you would have been if you bought them at full price. And it's something that I like taking advantage of. And Alex, I know we've said before that trying to time the market's like a fool's errand. It's a really difficult game, and we're kind of advocating here to just buy the haystack and that'll have the needles in it somewhere. Just buy the whole thing and sit and wait and get on with your life and enjoy it. So with that in mind, I don't time the market. I don't plan when I'm going to buy, plan when I'm going to sell. That said, I do keep a little bit of spare cash in case there is a market dip, and this is money that I've taken out of my emergency fund. And I took £1,000 out the other day, and I bought some extra stocks because they were on sale, and that will pay future me better. And over the coming months, I'll add what I've taken out of my emergency fund to replace it. And I realised that it caused me to reflect on how much I had sitting in cash. And I felt like I had too much. I was overweighted to cash. So that again helped me with my decision to put a little bit more into my kind of stock portfolio. Alex, can I ask you about kind of volatility? We mean basically prices go up and down. That happens in everyday life anyway, especially at the supermarket. One day you buy, I don't know, bread and it's £1 a loaf, and the next time you go in and it's £1.10 or whatever. So that happens anyway. But in terms of the volatility, like I've heard it mentioned that it's the price of admission to the stock market. So to get outsized growth, and what I mean by that is index funds return anywhere between, I don't know, 6 and 11% per year on the higher end as an average for something like the S&P 500. And when we think about achieving 11%, like we're never going to get 11% out of a cash account at all without a shed load of risk and it being a bit pretty unregulated, a little bit loan sharky and kind of terrifying. So in order to get those big returns, the price of that is taking some risk with your money, and potentially you could see its value decrease. But you only actually lose money if you sell it. So if you were to keep your investments just invested as they are and not touch them, not do anything rash, make any rash decisions to sell parts of your portfolio and move it to cash, you still own the underlying shares. So you give it more time and you wait for those share price to go back up. And I can pretty much guarantee you'll be thankful that you didn't panic sell.
yeah, definitely. And I think that price of admission is a nice term, and because I guess in the hierarchy of investment options, cash is the lowest. You're never going to lose money with cash. You will potentially lose it after inflation, so like your real return, because that will erode the value of it. Bonds then sit above that, so bonds are a lot less. So there's zero volatility with cash, i.e., the price of your cash in your account doesn't go up and down. The a bond, so the bond prices do go up and down, but nowhere near as much um, as equities, and that reflects in the return that they offer. So bonds will offer a higher return than cash, but not as much as equity. But because equity, it is a riskier investment, the prices go up and down a lot more, but over time um, they do tend to rise. And over the long term, equities have always outperformed bonds, and bonds have always outperformed cash. there will be time periods where it might be the reverse. So cash could outperform both of them. Bonds could outperform equities. And I think over the kind of the last, it might have been the what was it? No, the mid 2010s, when interest rates went to basically zero, bonds performed really well, um, and probably akin to equities. But over the longer term, so 50 years plus, so your kind of your lifetime investment horizon, equities always do better. And just before we started the pod, I did a just looked at a couple of the indexes which have been on the news recently, so that and just looked at their returns kind of in the short term and then also over the longer term. So just to give you an idea of returns on here. So the Nikkei, which is the Japanese stock market, so that was on Monday morning was the minus 12%. Over the last 5 days, that stock market has gone down by 3%. Over the last month, it's gone down by 14.5%. Over the year, it's actually increased by 7.5%. And over 5 years, it's gone up by 69%. The NASDAQ, which is like the tech heavy American index, over the last 5 days, that's down 3.5%. Over 1 month, it's down just over 9.5%. Over the year, it's up by 19.6%. And then over 5 years, it's up by about 106%. So you can kind of see the trend where it is that short-term volatility, but over the long term, you're still getting much higher returns on your investment than, say, 4% or 3-4% that you would potentially get in cash at the minute. But yeah, I think that just kind of demonstrates that some of the noise that you get in the short term, which is much like balanced out over the longer term, and hopefully just gives you a bit of comfort that holding onto your investments, staying invested is the right course of action, and not to panic sell and go to cash when the stock market goes down a bit.
I think you're, well, obviously, I agree with you because it makes perfect sense to me and hopefully to our listeners as well. But I was just thinking while you were talking, you said at the beginning your Yahoo Finance kind of blew up and everything's red, and they're talking about a Japanese Black Monday, etc., etc. And they're really spreading panic and fear. And this is how stock market prices kind of can fluctuate as well. So people, we are kind of pack animals. Have you ever seen kind of a video where someone's in a mob and they're kind of fearful because there's other people are fearful, but actually in reality there's nothing happening? People react to other people, and that fear or worry, that anxiety response is a real deep ingrained part of our brain. It's really in the central of our brain called our amygdala. And that's the part here that's activating. And you're thinking, actually, what is someone else must know something that I don't know. Therefore, I'm going to follow the crowd. I'll follow the herd because that's originally what's kept you and every member of your generation alive, so you can exist. So it's a real strong urge inside you. You have to be a little bit robotic with investing, which is why I think people find it quite difficult. So say that there's a kind of a broad amount of people across the world who are investing. The Japanese stock market, for whatever reason we might not know, takes a little bit of a tumble. And then people start to panic and they're like, oh my God, what if it comes over here? What should I do? I need to think about my family. I need to think about my life. I haven't got an emergency fund, la da da. And then people come back around and they're like, actually, someone else has done that. So they must know something I don't know. So I'm going to sell as well so I can feel safe. And actually, you end up talking yourself into the wrong decision based on what someone else might have thought. And they've probably got it wrong as well. And I feel like, as well, in the 21st century, media outlets and people can post stuff and news stories get written in rapid time. And it's like an instantaneous response. And we all know that bad news sells, and just Andy Hart before has explained the word news means negative events world service, and it just drives poor decision making, especially around finance. And Alex, I don't think, and correct me if I'm wrong, and I'll be very surprised if I am, but you had loads of stories about the stock price dips over the last kind of couple of days, especially the 5th of August. did you get any kind of article in green with a happy face saying over the last couple of years the this kind of index fund has gone up by what did you say 100 and something percent?
Yeah, the Nasdaq was at 106% over the last 5 years, but yeah, I did not get a counter article saying, actually, guys, we need to think about the long term, and volatility is all part of it. It's as I think, as you said, the the job of news outlets is to get eyeballs and to get readers, and
To sell stuff.
100%. And the more clickable you make your links and notifications or whatever, the more traffic to your website and not to others, which, just is. So there's a lot of sensationalist stuff that comes out, and
It
it's
sells and they make more money.
100%.
It's a selfish thing, and in this world of where what people watch and what people view, so you can sell them advertising space. That's a humongous multi-deca-billion-pound business per year. So that's why people use words like shocking and Black Monday, etc., because it just pings this little fear center in your head, and it makes you pay attention. It heightens your awareness and your senses. So people will probably remember kind of where they were when Boris locked down the UK, and they'll remember that because it mattered at that time, and it really leaves an imprint in your memory. It's almost like a trauma response in how that works. And I'm not saying it's traumatic in any way, shape, or form, but it does have an impact on us as humans, and we're all fallible like that. I feel like if we really pay attention to all of these news outlets, we'd constantly worry and nobody would invest or nobody would make wise financial decisions. And you can't, not you can't, but you don't get the counter story that says, actually, guys, it's gone up over 120% in 5 years. This is a 3% dip. Please don't panic. That's the voice of reason. That's the rational voice going on, but that's not publicized because it doesn't sell. So you have to zoom out, take a broad, big picture view, a little bit like your investing lifespan. Like I'm going to be investing for 20, 25 years, 30 years, something like that, probably longer. And if I got kind of delved in all these nitty gritty little things that happen all the time, I would be constantly anxious, and I don't think it just wouldn't work for me in any way, shape, or form. So I trust the process, put what money in I can, and I live a good life as I go because I've looked out and I've seen the big picture. So if anyone kind of was curious about this, if you think about the COVID pandemic as a recent thing, and then before that, you had the 2008 financial crisis, and then the dot-com boom, kind of 99 to 2001. If you look at, say, something like an index fund, perhaps the Nasdaq, over that time frame, and you look at 100 years of the chart, these small drops, like the COVID drop and the 2008 drop and the the dot-com thing in 2000 and 2001, they look like tiny little V shapes on the chart. But at the time, it's panic this, panic that. Oh my God, the world is ending. People are jumping out of buildings, etc. And if you kind of zoom out and you think you take a huge wide-angled lens picture and you see the whole thing, you'll realize that actually society will carry on. You back human ingenuity, and in 5 years' time, or probably less, you won't really remember it too much. And if you trust the process, you're buying stocks when they're cheap, and it really pays off. I mean, I know a lot of the money I put in over the COVID pandemic has made me far richer now than if I were to store it in a 4% cash account, if you could get one of those at the time, which you couldn't.
Yeah, quite right. It's interesting that you're mentioning about zooming out for the long term. So I was doing that actually on the app here, and it's so on the Nasdaq going back. I think it starts at 1988. Does this chart and as the baseline of 100, and as of today, the increase from that point is 16,580%.
Wow. Do you mean 1908?
No, 1988.
Wait, 1988 is 36 years ago. That's the year I was born.
Yeah,
So in 36 years, it's gone up 16,000%.
that's right. Yeah. that's
Wow.
because a lot of that is the boom from the tech because Nasdaq is out.
Yeah.
The equivalent for Dow Jones, I've just got it going back to 1994.
Hmm.
That's gone up by 1,143%.
Yeah, more reasonable.
So
But if you think about that, like you're never going to get that in a like no bank is going to offer you 1,000% over what is it 20 year for 30 years.
yeah,
It's just not happening, and that'll be some kind of shady bank. Like, what are they doing to be able to do that and make it profitable? They're just not
exactly.
doing anything legal or anything like that. So I really think kind of don't get caught up in your emotions. Don't listen to your taxi driver or your mate down the pub.
Mm,
Trust the process. And what I've done as part of this is when I started investing, I know my own brain, right? I do overthink stuff from time to time. So I wrote myself a letter and I dated it. And I can't remember the date. I should have got it out actually before we hit record. And I wrote on it, this is why I'm investing. So I'm investing for my future, my wife's future, and any future children we have to make their lives easier. And I won't sell as a result of market movements, news events, or anything like that. I will sell when I plan to sell, which I think I wrote will be at least 20 or 30 years, something like that. And I've never had to look at it because I spent a few times, like I wrote it out a few different times, and it's kind of ingrained itself in my head. And I have the words of Andy Hart, who runs the Maven Money podcast. That's excellent. A super resource if you haven't heard of it. He's a financial advisor himself, and I kind of have his voice in my head, and he's like, trust the process. You know it's the right thing to do, even if it feels uncomfortable. It's the price of admission, and you'll get outsized returns. And in the future, I want to be richer than I am now because it gives me more choices and more options.
yeah, I think that's yeah, so well said. And that kind of the letter to yourself is quite. It's almost like I've seen it before as part of like an investment management process. Is you write yourself like a policy statement or a document, and it is very much like this portfolio will be constructed of 80% stocks, 10% bonds, and 10% property. It will be held, indefinitely, always in those things, and reviewed, whatever, and rebalanced every year. And it's something along those lines, but it's almost like that rational instruction to yourself outside of this, oh, well, the market's down, I need to be going mad. It's like, no, like, look back to that
Actually,
document
you don't.
and that policy, and
Yeah.
it's a really useful tool.
Chill out a little bit. I mean, no one makes like there's never if you're going to make a big life decision, would you rather make it with a calm, level head without any stress or any emotions going on, or do you want to make it when you're in an absolute emotional state and you're not thinking straight? Because you can't think straight. And we've discussed before about when we get into these anxiety-driven states, that the front part of your brain, your prefrontal cortex, where your rational thinking is, that switches off because you don't need it at that point. The anxiety bit takes over, fills you full of adrenaline and stress, so stress and cortisol, to fight or to run, or to freeze, I guess, at this point. So you don't need your rational thoughts. So if you're trying to make life decisions around your stock portfolio, when you're in that heightened state, you literally cannot do it. So that's why people make mistakes. And it's that thing again of the stock market doesn't lose money, people lose money because they make human based emotional decisions about something that's purely rational. Like the stock market doesn't care that these world things happen and its prices move. It's going to continue to do its thing over time. It's not bothered. Who is bothered is us. It's you. It's me. It's whatever we've got going on in our life that impacts the decisions we make. The companies of the world are just going to continue to churn out what they do and make money in the long run.
100%. And I think as well, this is another reason, and we mentioned it in earlier episodes about automating your investments and almost the least amount of friction you can put between, say, you getting your payday and your money going into the stock market or into your investments or emergency fund or paying off debt, whatever else it is. But if you're investing, if it goes in and on the certain day of every month, X amount goes out of your account, you don't do it, and then that gets invested automatically on your behalf. That is the best way to stop yourself almost interfering. And I mean, luckily, like this, the dip happened, and I think we were texting actually. And
Yeah, I asked you if you were going to put any more in.
yeah, I mean, funnily enough, I did get my tax rebate the other day, so that came in quite handy. But that went into my ISA. But also my like regular investment just happened to be it always happens on the same day every month. It goes in on today actually. That's where my and I've got a list of investments that automatically get purchased. So my money goes in and then they get bought. And it just so happens that this the slight downward movement this week means this month I buy more of the same investments I've been buying for a long time with that money. So, but I just because it's automatic and set up, it just you know it's ideal. There's less of me in the middle of it.
And that's the key thing. Like robot, like I've heard it said before that robots are better invested than humans because they're not kind of squishy. They don't have emotions. They'll just do the mathematically correct thing, like 100% equities all the time, never sell, keep going. And it's the human part of us that's I mean, we're all 100% humans, of course, but it's that other kind of thinking brain, the emotional bit rather than the rational bit, that makes investing more difficult for humans. And I've heard it before that I think it was Warren Buffett's investing partner,
Charlie Munger, yeah.
Charlie Munger, that's the one. I couldn't think. I kept thinking of Charlie Poor for some reason, like his book, Poor Charlie.
Oh yeah,
That wouldn't come into my head at all. But he basically says the only like you should just never interrupt your investment portfolio unless you absolutely have to, and until then, don't do it. And it's true that the best investors are dead because they leave their portfolios alone and they just don't meddle with it. Humans, we meddle, we tinker, we try and improve. And what happens if you do that in most areas of life, you'll come out on top. But if you do that within your investment kind of career and your portfolio, the odds are that you're going to lose. You're going to lose out. So the more tinkering you do, the worse you're going to come off at the other end of it. And we've said before that there are loads of finance professionals with loads of kit, loads of brains, loads of experience. They can't beat the market with all of their stuff consistently. They might do it 1 or 2 years. They can't do it for multi decades in a row. So if they can't do it, I don't have all of that kit at my disposal. I don't have the time to give that either, or honestly, I don't have the intelligence to give that either. It's a lot of stuff that I don't understand. So I just prefer to buy the haystack. In this case, it's the whole index fund. Yeah, and get on with life. But there's another kind of thing I thought about whilst you were talking is the idea that kind of automating your investments and your buying choices, it really removes that choice and that thought from your head. So if I, Alex, were just to give you, say, £1,000, for example, and I said to you, Alex, I want you to invest this somewhere, and then I give it to you, and you've got a lump of cash, and you're like, oh, actually, I don't have to invest it. I could do with that pair of shoes, or I could do with this extra thing, or I could do a million things with it. Whereas if I say to you, actually, I've transferred you that much money and I've put it straight into your investment account, then that decision, that there is no decision because it's already done. And it's past you or current you, if you're not already doing this, helping out future you by removing all of that fatigue and brain power of kind of fighting and battling your emotional state for those decisions. And it's an easier way of living life with less decision fatigue.
yeah. I think that's a yeah, perfect way of doing it, of saying it. Just remove yourself from the equation almost, and just once you set up the system, as long as all you have to then do is just make sure that yeah, the money's there for it to get taken from your account every month or whatever, and then leave it and just yeah, focus on other things. And
Yeah, trust the process and get on with living. Like get on with booking your holiday or I don't know, negotiating a pay rise or anything else we've talked about. So what we don't want people to do is just get totally tangled up in the weeds with this. We try and break it down and simplify it so it's not so scary. You're probably doing it anyway with a workplace pension, so it doesn't mean you can't do it yourself with your own managed portfolio. Like this is something, if you learn about it, you don't need a financial advisor for either. I would only utilize their skill set if you've got a really kind of difficult tax problem or a retirement problem, or you're having a big life change that you could get some paid time with an advisor, something like that. But setting up an ISA and a self-invested private pension or a SIP, you really don't need to be paying someone to do that. You 100%. If you're here and you're listening to a podcast and you can figure out your podcast player or whatever on your phone or your laptop or wherever you are, you are capable of setting yourself up a stocks and shares ISA. I can guarantee you that.
Yeah, 100%. Couldn't agree more.
Hmm. Any other thoughts on stock market volatility or anything else fun that you've learned or done this week?
I think I've got a couple of analogies, I guess. Or there's one. Um, I think when it's comes to investing in the stock markets, I always read a quote or heard a quote or something, which was it's akin to like walking up a hill with a yo-yo, and that the yo-yos are that the price is going up and down, but ultimately the long-term trend is you're going up a hill, and so it is increasing. Um,
Yeah, so long as you stick to the process and you keep walking in the same path, you're eventually going to reach the top of the hill
Absolutely, and
with your yo-yo.
with a yo-yo in hand, yeah. And then just there was I think a quote by Nathaniel Rothschild, so one of the richest men to ever live, and I think he had a quote around something along the lines of like buy when there is blood in the street and sell when there is joy in the air. And I think that's the essentially buy low and sell high from a guy from 1400 and something. But
I mean, that makes sense. Easy to say, perhaps sometimes difficult to do in practice, but and that
100%.
that makes the difference, doesn't it? So the person that buys when things are through the floor, and they've got some spare cash and they've got the rest of their life sorted out, that they're not scrabbling around for money, that's the person that will get outsized returns. And when the world returns to normal, that they'll be much, much richer than kind of everyone else. I mean, if you think about the Great Depression or something where things tanked like humongously, and I don't have a figure, a percentage, Alex, in my head. If you do, chuck it in of how much the stock markets went down at that point. But if you put some money in at that point and you just sit on it and you wait, and yes, it's time. It takes a lot of time, and you do have to hold your nerve and trust the process. But I can't imagine how much money you would have if if that would have been the case. It's generation changing money.
Yeah, I think it was down like 90% for over like was it 1929 to 1931. So it takes quite a lot of yeah, nerve definitely to get into that. But yeah, I think it's as you said, generational levels of wealth that can be made.
Yeah, absolutely. I've just Googled it, so sorry if you could hear me
I was,
typing. So yeah,
I was waiting with bated breath for the
the
Google result.
stock market crash of 1929, a sharp decline in US stock market values contributed to the Great Depression of the 1930s. It lasted 10 years and affected both industrialized and non-industrialized countries in many parts of the world, but it doesn't give me where's the percentage of it going down? Uh, so it says by November 13, 1929, the market had fallen to 199 points. By the time the crash had completed in 1932, so it took 3 years, following an unprecedentedly large, so no one saw it coming, right? Economic depression, stocks had lost nearly 90% of their value. That's a 90% off sale. I mean, of course, this is a high level thing. We're basically ignoring all of the difficulties and the troubles that come from that. But I really hope that doesn't happen again at all. But that's basically what we're talking about. It's a humongous sale at that point. And if you have some cash and you're brave enough, that is the time to make generation changing money.
Boom, got it. I think that's a great way of ending.
Yeah, agreed, agreed. And this has been episode 34. So thank you to each and every one of you who've got this far. Again, if you have any questions or any thoughts or any creative ways of managing stock market volatility, do email us. So it's just nursingyourwaytowealth@gmail.com. Alex and I read all the emails and we reply out to them as well. Either one of us will do it or we'll both do it. But we appreciate all of your time and you for spending the last 40 minutes with us, and we'll see you next time. None of what we discuss on the show is to be considered financial or health advice, and we recommend you always do your own research or consult an independent financial advisor or a doctor when making your financial or health decisions.